Good afternoon, good evening, morning, wherever you are. Welcome to this session on international project finance. I'm very pleased to welcome you to this event, which we are organizing in partnership with Project Finance International and with the Global Infrastructure Hub, a G20 initiative. My name is Richard Bolwin. I'm the director of the investment research branch in UNCTAD. Now, this session on international project finance is a very important part of our World Investment Forum going on right now. We have, as you may have seen on the program over the course of this week, more than 90 sessions, but this particular session is very close to my heart. And that is because, well, on the first day of the World Investment Forum, we published our Global Investment Trends Monitor. And it's full of data, of course, and actually what you can see there, that international project finance is arguably one of the main, if not the only, real growth diamond for global international investment flows that we are talking about here at our World Investment Forum. So it's an important part of the forum in that sense. In reality, international project finance wasn't really our original focus in UNCTAD, in the division on investment in UNCTAD and in our annual World Investment Reports. Our bread and butter has always been investment in industry, multinational enterprises. Our constituencies were investment authorities, investment promotion agencies that have, until recently, focused mostly on industrial investment, on attracting investment, generating employment. That's been the main focus always. Also, one of our main areas of activity, international investment agreements, are often written for traditional multinational enterprises and their foreign affiliates abroad. So it wasn't one of our original focuses, but since a few years, we have really started looking at international project finance in much greater detail. And I could say that happened really from the adoption of the Sustainable Development Goals, right? We started publishing our SDG Investment Trends Monitor, and realized very quickly that 3/4 of international project finance is really in what we call SDG relevant investment sectors: infrastructure, renewable energy, power, water and sanitation, health. So a lot of international project finance is really relevant for the SDGs, much more so than industry investment, which we proxy with greenfield investment. Only a small part of that goes into what we at the UN call SDG investment sectors. We also realized that international project finance in terms of size is ballpark the same as international investment flows in industry, as proxied by greenfield investment. And if you look at our latest Global Investment Trends Monitor published on Monday, this year it is actually set to exceed it. International project finance, as we measured it, is growing at 30% in number this year and about 70% in value. So growing fast. It's even becoming more important now because of the post-COVID recovery packages adopted in many countries, right? Which include long-term investment stimulus. And well, if we look at the data that we published in the World Investment Report this year, and you add up all the recovery investment packages worldwide, you now get to about $3.5 trillion already. And that sort of amount is really, it will inevitably affect international investment flows. Now, in the World Investment Report, we pointed at a series of challenges that will emerge with such a vast increase in project finance in infrastructure around the world. Let me just highlight two, which I will think will be an important part of our discussion today. One is the capacity or implementation problems it might cause. And we measured in the World Investment Report that the implied increase in infrastructure spending over the next few years, implied by these recovery packages, would imply 3 times the fastest growth achieved in the past decade. So you can imagine that will cause quite a bit of capacity and implementation issues over the next few years. A second challenge, which is even more important, is of course that out of that $3.5 trillion I mentioned, almost all of that is of course adopted or defined by and for developed countries, right? Only about 10% of that is aimed at developing countries. And being UNCTAD we're developing country or development organization, that of course is a very important challenge for us. So the objectives of our discussion now, apart from hearing different perspectives on the landscape and the prospects for international project finance from our various speakers and panelists, I would really like to hear some ideas and on the policy implications and of the recovery packages, and some ideas for how to boost the capacity of developing countries to attract international project finance, and specifically international project finance in SDG relevant sectors. So that's my objective. Now, to do this, to achieve this objective, we have a set of stellar speakers, which we're very proud to have. And let me move on right now to our first keynote speaker before we move on to the panel. And our first keynote speaker is Mr. David Craig. He's the former CEO of Refinitiv and a senior advisor of the London Stock Exchange Group. Over to you, David, for your keynote speech.
Thank you very much, Richard. Good morning, good afternoon to everyone with you. I wanted to set the scene, if you like, by giving some of the key data that we have and track on global infrastructure. As a leading financial infrastructure and data provider to the world, infrastructure is becoming a major asset class. We track on a daily basis all the world's major infrastructure projects, from those rumored to those planned, finance, contracted, underway, completed, or going through subsequent phases. So it's a really important part of the service that we offer around the world. We have a database that goes back 45 years. We track 55,000 projects worth over $31 trillion from 100 countries. 9 trillion of those, and I'll talk about that in my introduction, is now from emerging markets. So clearly this is an important and very large growing part of the global infrastructure opportunity that the world faces. And according to several sources and many sources, and Richard talked about the infrastructure funding gap, there's a significant gap. What we're trying to do is help people through that gap by having more data and transparency. Our data is used by infrastructure professionals, investors, banks, development banks, government agencies around the world to really understand the opportunity in infrastructure projects, be they financing, investing, or providing professional services to this really important and growing part of the global economy. I'm going to give a couple of slides to summarize the data, and if we could just turn to the first slide. This is just a summary of some of the key findings that I'll go through from our very latest view of our global data on infrastructure. I think the big news is that infrastructure investment has already overtaken, in 2021, has already overtaken 2019 year to date. So it's already larger than all of the infrastructure investment that happened in 2019 across the world. And in developed markets in the US, UK, and Australia, infrastructure accounts for just over 40% of the total share since 2019. So the developed markets are still a very large part of that investment. But the investment in emerging markets is recovering, certainly post-COVID-19, with India in particular now a very highly favorable environment for investors. The total value of announced projects in 2021 is well over 300% higher than in 2020 in India. China's Belt and Road Initiative that has a lot of focus over the last 6 years since it was announced continues to expand, even through COVID, with 2021 on track to see the highest investment in the last 5 years. And overall, across the combination of developed and emerging markets of the G20, what's really interesting is the growth in renewables. We're seeing now over 285 billion in renewables projects have been announced just this year to date in 2021. This is over 50% higher than the renewable projects in 2019. And in fact, renewable projects now in our database count for 30% of all of the new projects that are happening. That's up from 20% in 2019 and 10% just two years before that. So we're seeing 10% increase in renewables almost every 18 months now, and I think that trend is not certainly going to go away. So in summary, infrastructure investment is large, it's growing very quickly, it's already overtaken where we were in 2019. and the emerging markets in particular is growing. If you can just turn to the next slide then, please. As I said, in the developed markets, the US, the UK, and Australia infrastructure accounts for just over 40% of the total G20 share. The US, the UK, and Australia are top of the list when considered total value of projects, and with high value projects in the US, such as the Baltimore-Washington superconductor maglev, a high-speed rail connecting Washington, DC, or JFK International Airport redevelopment projects, so very big, massive infrastructure projects that have been underway. And if President Biden's infrastructure bill passes, of course, we'll expect to see even greater volumes of projects be announced. But the next slide, if we can show that, also shows the emerging market coverage. And here we see a real bounce back in the emerging markets. It dipped in 2020, but it's already bounced back in the first 9 months of 2021, both on the number of projects and the size of projects. Investment in the Middle East, for example, has increased from 85 billion in 2019 to around 133 billion in 2021, just year to date. So again, a 50% increase. I mentioned India. If we could just turn to that next slide. For India, Italy, Saudi Arabia, the overall value of announced projects has increased 61%. From 85 billion in 2019 to over 137 billion in 2021, just year to date. And infrastructure investment in India now accounts for 78% of all investment announced across these 3 countries. The total value of these projects is really growing very fast. And this infrastructure sector has become a very big area of focus for the government of India. They've pledged to spend 1.5 trillion on infrastructure between 2019 and 23. To really focus on sustainable development of the country, recognizing that there is a big infrastructure gap, but also there's a renewable energy gap that has to be filled in the Indian environment. And the latest project finance from Q3 from Refinitiv shows the international bond issuance for India projects rose to 3.6 billion, up from just over 600 million in the period last year. So again, shows that the debt financing for these projects is growing really quickly, and this makes India a particularly appealing market for investors. If I turn to the next slide very quickly, the value of renewable projects being announced in emerging countries has largely held steady over the last 3 years. The number of renewables projects has dropped very slightly, 223 projects announced in 2019 versus 214 in 2020 and 201 in 2021, and you see the mix is roughly the same. But when you dig a little bit deeper across LATAM and the Middle East, if you look at the next slide, please, solar has seen, as you'd expect in these regions, greater investment, both in terms of the number of projects being announced and the total dollar value as well, with 340 solar projects announced since 2019. A value of just over 40 billion compared to 214 wind projects. So you see it's quite close between them, but solar has the edge, possibly because of the area of the market that we're looking at. And I mentioned China's Belt and Road Initiative, launched in 2013, still considered still is the largest investment program in human history. If we turn to the next slide on that, what it shows is that we are still seeing expansion in Belt and Road. Momentum has not slowed in recent years, even through COVID. The amount of direct investment in the BRI countries was 22% higher in 2020 than in, say, 2016, just a few years ago. So the growth will continue to go on, and the full year figure we expect to surpass 2020's total. And when we look at the status of these projects, if we just turn to the next slide, 17% of all BRI projects are now completed or actually operational as well. So it's tracking, this is a global tracking database of how many of these are actually completed or operational. And there's a growing amount that are actually in that status as well. So this is not just about new projects being created, but about taking projects into operation as well. So this was a very, very quick dip, if you like, into the data. If I turn to the very last slide and just try and summarize this for you. Infrastructure investment in 2021 across the G20 countries, it's already overtaken that of 2019, probably a reflection of the infrastructure gap, the huge investment that's going into recovery. In those developed markets, the US, UK, and Australia account for 40% of that G20 share, so still a very high proportion going into those markets. but the investment in emerging markets is recovering post-COVID-19. India in particular being a highly favorable environment for investors. And China's Belt and Road Initiative continues to expand as well, and we're on track to see the highest investment. And overall, across the combination of developed and emerging markets, 285 billion in renewables, that's a 50% increase, and renewables now accounting for almost 30% of all the projects in 2021, up from 20% in 2019 and 10% just a few years below that. So some really important and emerging trends. Hopefully this was a useful pit stop of the data just to give an overview of where is the project's been announced, where is the investment flowing into global infrastructure projects. And with that, I'll hand back to Richard. Thank you.
Thank you very much, David. It's a very good overview of what's happening there with the data. We, of course, in UNCTAD also use your data to come to our own figures on the international flows and international project finance. So thank you very much for that, and I appreciate the focus on emerging markets, as you call them, developing countries. Of course, we are talking always about the G20, or you mentioned a few G20 members. Our concern is, of course, also in what happens in the lower income countries, and trying to see what mechanisms we need to promote international project finance there. And perhaps we'll get a chance to hear some examples of that also later on in the discussion. Let me pass on now to Marie-Lam Frendo, who is the CEO of the Global Infrastructure Hub, which is a G20 initiative. Marie-Lam Frendo is currently traveling back from Rome to Australia after the G20 infrastructure working group meetings. So she has given us an address on video. Thank you.
I'm the CEO of the Global Infrastructure Hub, and I'm delighted to be joining you today. For those who are unfamiliar with the Global Infrastructure Hub, we are a non-for-profit organization that advances the delivery of sustainable, resilient, and inclusive infrastructure. Formed by the G20, the GI Hub works collaboratively with the public and private sector to produce data, insights, knowledge tools, and programs that equally inform policy and delivery, helping decision makers and practitioners create positive impacts for infrastructure. Every year, the presidency of the G20 rotates between member countries, and the current G20 presidency, Italy, is about to hand over to Indonesia, who will commence their presidency in November. Over the last 12 months, the Italian presidency has focused their infrastructure agenda on actions to assist a return to a strong, sustainable, balanced, and inclusive growth. Infrastructure remains a priority in the context of COVID-19 recovery at the G20 levels. There is a broad agreement that infrastructure investment can be an engine of economic growth. To that end, last year, the GI Hub prepared for the G20 a report on infrastructure recovery post-COVID-19. This report established that, first, public investment, including infrastructure, is more effective in increasing economic output over the medium term than other type of public spending. Second, on average, infrastructure has achieved a fiscal multiplier of about 1.5 within 2 to 5 years versus a 1.0 for public spending overall. And third, infrastructure investment can help achieve both local economic recovery and broader policy objectives aligned with the G20's quality infrastructure investment principle. Following this report, the IMF published a report that showed infrastructure spending is far more beneficial when countries coordinate their efforts due to spillover effect. So these findings reinforce the key role the G20 economies have in boosting infrastructure and the need to work together collaboratively and lead the way on policy. At the GI Hub, we believe that infrastructure is critical to economic recovery, and we are advocating for this infrastructure investment to be transformative. So what does this mean? It is defined as infrastructure that enables short-term economic growth plus long-term policy objectives in sustainability, resilience, and inclusion. This is coupled with a step in change in capability, creating new benchmarks for best practices. A notable silver lining from COVID, if I can say that, has been an increased focus on sustainable investment. The market sentiment is increasingly showing that people want to see corporations and governments investing their available money in quality and sustainable infrastructure. A widespread recognition by infrastructure fund managers, lenders, and investors of the importance of ESG principles, the environmental, social, and governance risk criteria investors use to screen potential investments and assess their long-term value, appears only to have strengthened since the global pandemic. So aiming at this transformative recovery, the G20 tasked the GI Hub this year to track the amount of infrastructure as a stimulus announced by G20 governments and present data insights that will help governments, investors, multilateral development banks, and project directors achieve not only economic growth and productivity, but also transformative outcome from infrastructure in the post-COVID-19 recovery. This tool is called the Infra Tracker and was developed in close collaboration with the International Monetary Fund, the IMF. It was presented to the G20 finance minister and central bank governors last week and referenced in the October progress report on the G20 action plan. In a few weeks, we will make the tool publicly available free of cost on our website. So in that tool, it is reported that between February 2020 and August 2021, governments announced $3.2 trillion in infrastructure as a stimulus, which is equivalent to 3.2% of GDP across G20 members and guest economies. Using the IMF analysis of the time horizon for COVID-19 related fiscal measures, it can be assumed that around 90% of this stimulus could be spent within 2 years of its announcement. If spent in the next 2 years, this investment would represent a 45% increase in yearly infrastructure investment compared with 2019 levels. So to support even further this transformative recovery, over the last year, we've supported the G20 infrastructure agenda by working with their infrastructure working group on the role of infrastructure in the transition to a circular economy. So this activity has included a workshop for the group's member on the topic, a thought piece on the role of infrastructure in the circular economy, and by the end of October, we'll publish the Circular Economy Roadmap to provide high-level guidance on how to transition infrastructure towards a circular economy. This is a new but very urgent topic for the G20 if we want to deploy the stimulus forward towards achieving transformative outcomes. So the circular economy is a very powerful solution for meeting long-term climate change objectives, plus reducing supply chain risks and short-term shortages. It can be integrated into infrastructure itself, and infrastructure can in turn support circular economy activity. But the GIM also supports very practical solutions. And I'm happy to report that we're continuing our work started under the 2020 Saudi presidency of the G20 on identifying innovative funding and financing solutions. There are many ways to successfully structure deals. So we are assembling case studies and guidance on the latest best practices. And it's true that infrastructure could feel very technical, but in reality, it's not always rocket science. So this work really helps to know what others have been doing successfully and replicate and scale up those solutions. So we're very pleased to partnering with the IFC to showcase some of this very successful transaction through a webinar series, which is ongoing. So this initiative is aligned with the G20 Quality Infrastructure Investment Principle to help significantly improve the efficiency of delivery and the ultimate outcome and quality of infrastructure. So thank you for this opportunity to deliver this very brief presentation today. I encourage you to explore the GIHub's website and also to connect with us through our newsletter, but also social media channel to find out more about our upcoming tools. Thank you very much.
Thank you both David and Marie Lamfrando and colleagues at the Global Infrastructure Hub, who've been extremely helpful in finding this solution to our travel problem. A very welcome introduction. I heard the latest data on the expected increase in infrastructure investment over the next 2 years. So as I mentioned as well, that's going to bring us some real opportunities, but also some challenges that I think will now be part of the panel discussion. And I'm very much looking forward to this panel discussion. It's going to be an important guide also for us, for me, in a project we will be launching soon on international project finance in SDG sectors to deepen the work on this. So this session is a very helpful guide for me for that. The panel discussion in particular, and for the panel discussion we have an extremely experienced moderator, Rod Morrison, who is the editor of Project Finance International. And I hand over now to Rod to introduce our panelists and to moderate this session. Rod, over to you.
Thank you very much, Richard. So welcome everyone to this exciting panel discussion on boosting project finance investment in infrastructure and sustainable development goals. As Richard said, we have a very distinguished lineup of speakers to tackle this subject. First, I'd like to introduce myself and make a few opening remarks. As Richard said, I'm Rod Morrison, editor of Project Finance International. PFI, as David said, is now available on our global Infra360 infrastructure platform, a platform bringing together a comprehensive suite of data and commentary on the global infrastructure market. Refinitiv is now part of the London Stock Exchange Group, LSEG. So to start, project finance is a financing technique within the infrastructure finance space. Today, Refinitiv has issued the Q3 numbers for global project finance activity, showing the loans market was up 11% to 208 billion US dollars year to date, and the bond market was up 65% to $55 billion on the same period last year. Notable standouts in the loans market include the Middle East, as David mentioned, where activity doubled to $39 billion, and Central America, where loans activity was up 84% to $6.8 billion. Activity in South America was up 10% to $12 billion. Activity in Africa nearly halved to $2.8 billion, but leapt in Eastern Europe by more than 300% to $19.9 billion. Stand out in the bond market, where, as David said, volumes rose 500% to 3.65 billion, driven by dollar bond issuance. These numbers are an important guide to the state of the global project finance market. But an important caveat is that large trophy deals in the sector can distort the figures quarter by quarter. In Q3, the Jizan refinery utilities financing arranged by Aqua Power, Air Products and Aramco in Saudi Arabia was one of the standout deals at $7.2 billion. Two large-scale metro lines were financed in Latin America, in Panama and Peru. The first large-scale offshore wind project was financed in the US, while Adani Green financed its hybrid solar and wind scheme in India, Project Emerald, via a 1.35 billion internationally syndicated loan. Impressive stats, but is it enough to meet the global challenges? One quick aside, how are these project finance credits performing once the schemes move into the operational phase? Middle East cumulative default rates are very low at 1.76%, while African, Asian, and North American schemes are at 7%. Latin American and Eastern European schemes are higher at 10.5%. That said, recovery rates on defaulted projects are good across the sector at 80%. These figures come from the annual Moody's Project Finance Loan Default Survey, backed up by an underlying Refinitiv dataset. Exciting times then, with project and infrastructure finance being called upon to help upgrade the world's infrastructure stock, while at the same time aiding sustainable development goals and fund wider cleaner energy policy goals. Just before I introduce our speakers, a quick housekeeping note. For those of you streaming this session on the conference app, You can submit a question to our panelists via the live wall feature on the right-hand side of your screen. So we could just have a brief introduction from our speakers before moving to our questions. Unfortunately, Meridian's Julia Prescott is unable to make today's session. So first, if I could move to Paddy Padmanabhan, who is the CEO of Aquapower, for a brief introduction. Paddy.
Thank you. Delighted to be joining you. My pleasure to join this panel on an exciting subject in a very dynamic world. It was very interesting, all the statistics that were presented earlier on by the three previous speakers. Look at the scale, look at the nature, look at how infrastructure financing, even though it's kind of coming from way back, is actually starting to move forward. I think at the panel session just now, we're going to be discussing some of the reasons, some of the opportunities to accelerate and to grow. But what I do want to point out is that it should all be done with the mindset that technology has given us infinitely more solutions than we used to have even as recently as 5 years ago. One of the reasons why renewable energy uptake has accelerated so much is not just because we are indeed all concerned about climate change, but because renewable energy has become so cost competitive. It's become cost competitive, driven by technology, driven by material sciences, driven by advances in computational power, a whole host of things. And that is going to give a very positive impact, even as we go forward into industry, into all the other infrastructure segments as well. Rod, I'm not quite sure how much you want me to sort of go on this. You've got other panelists to introduce, so let me.
Well, I just I just want to ask: we're at a sort of tipping point in technology. I mean, offshore wind and solar are now very competitive, but we're now moving to new areas like hydrogen, and which may be very exciting but less proven. Do you have faith that these new technologies will come forward in a competitive commercial sense?
Zero doubt whatsoever for hydrogen. Well, for a very simple reason, because I mean, I've seen the way renewable energy, photovoltaic energy, wind energy, offshore wind energy, floating offshore wind energy, all of that come forward so quickly, get taken up. Hydrogen is not new technology. It's Stone Age technology. Electrolysis is very basic. It's been there forever. We never were able to apply it at scale simply because it's a very energy-intensive industry, energy-intensive technology, and using fossil fuels to produce electricity and then splitting the water just didn't make sense in that energy-intensive application. Now that we are able to deliver renewable energy at such a cost-competitive basis, all of a sudden, electrolysis becomes very possible. And as we scale electrolysis, as we start to do more at scale and get the electrolyzers built, automated facilities and so on and so forth, no question whatsoever that green hydrogen will start to get produced in a cost competitive basis, and that will then drive yet another plethora of innovation.
Paddy, I must ask you about your IPO, which I think you've done this month. What will life be like as a public company going forward?
Thank you very much. It's so new that I'm still enjoying the honeymoon period. It was a hugely successful IPO, but more than that, I mean, look, yes, we need to start thinking about every quarter and so on and so forth. But underneath it, though, we are very much involved in delivering reliably energy and desalinated water at the lowest possible cost in bulk. That business model is not going to change, and the market is growing, so we're kind of well set. That's not the issue. But the interesting thing about this IPO, though, is I'm sure you know the data. For those who have not been following it so closely, we listed 11.5% of the company, company that's been valued at the day of listing at $11 billion. So something like $1.3 billion was to be invested in this company. $330 billion chased that $1.3 billion. It just to show and fast track the conversation of today, yes, we need to be concerned about money, but there is a huge amount of capital that is looking for the right home, desperately looking for infrastructure for companies that promote infrastructure, that invest in infrastructure, that develop infrastructure. So that's the message for me out of that IPO.
Thanks, Paddy. If we could move on to Nandita Prasad. Nandita is Managing Director, Sustainable Infrastructure at the EBRD. Nandita.
Hi, Rod.
Hi.
Very nice to be here and with one of my favorite clients, Paddy. I'm sorry that Julia couldn't be here with us because she's also a very favorite client of ours. These are the kinds of clients we love because these are the ones that actually come to our countries, that are willing to invest, willing to take chances and risks and partner with us because, you know, even with all the wonderful data we just saw, and it was really actually quite heartening to see that project finance is coming back and that developing countries are also benefiting from some of this boom. The reality is in many of the countries that we work in, where the infrastructure gap is also still the widest, we still see a lack of capacity and resources to implement the scale of investment needed. And therefore we urgently need private partners like Paddy, like Julia and many others, and we need to mobilize them. And we need to give these countries access to project financing. And I think that's what we see our role at EBRD to do in our countries, is really help them find ways to develop projects and be able to take them to the market and then see them through, as Rod, you said, not just to financial close, but right through implementation and stay with them to show, you know, what benefits project financing and private sector can bring to these countries and to be able to scale those investments up more for the future. And I'll stop there because I don't want to give away what I'm going to be talking about later.
Thank you, Nandita. Moving on to Graham Vinter, one of the leading project finance lawyers, who is now a chair of Covington's Global Project Finance practice. Graham.
Yes, thanks very much, Rod. I think what I should say to set up what I'm going to talk about in this session is probably that I've been involved on the legal side mainly of project financing now since around about 1982. So sadly for me, that spans 4 decades. But I think I've seen project finance as a technique evolve from a niche product really only used in the oil and gas industry to one that's developed now and is applicable not just to power but all types of other investments as well in infrastructure, including civil infrastructure, roads, bridges, things like this. For me, I think we should look upon the 4 or 5 decades worth of precedent that we have as a real strength. And part of my message is going to be, let's draw on that. So let's not necessarily reinvent the wheel. We have a lot of techniques already out there. Actually, we heard some of this in the previous presentation. Learning from deals that other people's done and the way that they've overcome very, very similar problems to deals that other developers will have is a great way to make progress in this area.
Thank you, Graham. And it's great to have Jorge Abrash, who is the VP Private Sector at the Development Bank of Latin America. We've heard about Latin America this morning. CAF, Jorge.
Hello, good morning and good evening to everybody. Thank you for inviting me for this very important panel. Hi to my fellow panelists. My messages are related to what we are seeing here in Latin America. A lot of needs, very deep crisis, but on the other hand, all or many governments in the region are very aware of the need to attract more and better the private sector. And CAF is working with many of those governments in order to help them set the right framework for investors to come in. That's my message, and I'd like to expand that later on. Thank you.
Thank you, Jorge. So moving on to our first question, which I'll ask our panelists in turn. How can developing countries gain greater access to international project finance for sustainable growth? Paddy.
Thank you. Look, I think as I've sort of, from our own development experience, and we are a company that's entirely focused in power generation and desalinated water production. So only there are 2 segments, if you like, of the wide range of infrastructure. But having said that, they are critical sort of components. Now, in these components, we operate in inverted commas emerging markets. We are able to attract project finance for countries like Ethiopia, countries like for sure South Africa, Vietnam, no difficulty. What is the key? The key is to have well-structured projects within a good macro legal framework of the country itself, projects that you can demonstrate you're delivering really competitive value. And the easiest way to do that is through transparent competitive tenders. But it doesn't have to be always transparent competitive tenders. It can be negotiated tenders or negotiated projects, provided you can really benchmark it and show that you are delivering competitive value. Because lenders are no longer just concerned about doing some basic creditworthy analysis, credit capacity analysis. They are looking, because what's the business that we are in infrastructure? We are investing a ton of money. We are borrowing a ton of money. And in order to make it affordable, we have to pay it back over a very long period of time. So it's not just about creditworthiness. It's also got to be about willingness to pay. The endurance of that tariff that you set on day one over 25 years becomes very critical. So it needs to be a very welcoming, trustworthy, well-regulated, well-structured environment where you are able to deliver competitive value. So those are the ingredients that will make a huge, huge difference. The biggest challenge that we find is that the needs are plenty and they are so easy to identify, but yet there is no capacity on the counterparty side. There is no conviction. There is no urgency. And private sector, I'm sorry, I've got a wide platform to invest in. Huh? So we are utterly impatient. We have no time. Time is money. So we're not going to hang around and wait. We're more than happy to help, to structure something, but it sort of spreads out into years, nothing happens. So it's all about the counterparty's capacity, counterparty's capability, and the counterparty recognizing the basic, very straightforward ingredients that are required to be able to support these projects.
I assume as you look at the various markets that the counterparty capacity differs from market to market. When do you get a sense that things are good?
When there is, the easiest one and the really successful, and I can give case histories, there is a very clear direction right from the top. Whether be it at a cabinet level, whether it's a president or the king, clear direction from the top. And then preferably an agency is set up. Unfortunately, it is the most efficient way to deal with these things is to set up virtually a new agency, because the existing infrastructure, the existing agency is so moribund. They are so stuck in their ways. It's impossible for them to break free of the legacy and the history. So it's important. So let me give you a quick 2 examples. South Africa had set up a fantastic renewable energy procurement agency inside the Ministry of Finance. Within that sort of messy government of the past, it achieved phenomenal success because it was led, there was fantastic leadership there. It had the cabinet support to set it up, and a really capable leader built a platform and kind of ran it very, very, very competently. Delivered a huge, stunning program. In Morocco, Mazen, same story. The king gave a very clear vision, set up a procurement agency, and then went out and followed through on the procurement. So you can do this in any country, provided you set up those right instruments and empower them and let them get on with it.
Well, just one very quick point, Paddy. You mentioned willingness to pay. I guess various agencies come in, but say 10, 15 years time, we don't know, governments change, and that's always an issue, I guess, with projects, that there's a lot of enthusiasm at the start, and then how do you judge that variable? In my business, it is somewhat easier. We are providing, but in fact, it should be the same for all infrastructure services, but it's a hell of a lot more easier for power and desalinated water, absolutely basic ingredients, right? And not just for economic development, but for life itself. Now, if I am able to deliver in a country like Ethiopia, photovoltaic energy at 2.6 cents per kilowatt hour, they're not going to switch the lights off. They're going to find it doesn't matter which government, they're going to make sure that they keep paying.
because it is so cheap or so competitively priced. And that's the price at which we are able to do it today. Not because it's us, that's what the technology allows us to do. And that's what the project finance instruments allows us to do. And okay, we are enjoying that sort of low interest rate environment. Let's not forget that. So it wasn't that, I mean, you know, some of us were still around when base rate was 12%. So it's a long time ago. Maybe people will not believe it. But okay, at least we are now in that. So all of that comes together, but let's take advantage of that and get on with it.
Thanks very much, Paddy. So moving on to Nandita.
Yeah, thanks, Rod. Well, you know, the good news is the one that Paddy gave us. There is no shortage of capital in the world. And as we emerge from the pandemic with the Damocles sword of climate change hanging over our heads, we can see there is far more interest than we've ever seen before from a wide range of developers, private equity, institutional investors, and lenders, especially for green and sustainable investing. But the not so good news is there are still not enough bankable projects in developing countries outside perhaps the large ones like India that David very optimistically told us about, to mop up all the money that's there and meet their needs. And not enough projects that are properly structured, backed by predictable and robust regulatory and contractual frameworks, and awarded under transparent processes. And again, as Paddy said, the key reason for this is a lack of knowledge, competencies, and capacity on the part of counterparties in developing countries. So this is where IFIs like EBRD can really come in and help to prepare and deliver the pipeline of infrastructure projects needed and build the capacity. So we have particular strengths. We work across the public and the private sector. We have a toolkit of policy dialogue, technical assistance, advisory support, capacity building, and we need to employ these to work upstream to deliver those projects for financing and ensure that we achieve that true value for beneficiaries and mobilize finance. So let me just very quickly highlight two programs we have in our toolkit, through which we are now generating quite a lot of project finance opportunities. So the first one is the one that Paddy talked about, renewables. We have a renewable energy auction program where we currently support tender or auction programs in about 14 countries. We work with the governments, we work with those units where we build capacity, the kind that Paddy talked about, and we actually work directly to design bankable contractual frameworks, implement competitive bidding schemes that are replicable and scalable. And we also work with our countries to do what, again, Paddy mentioned, which is very important, which is to set those high ambitious targets for renewables that signal to investors that these are not one-offs, but that they offer huge opportunities in the country going forward. And having IFIs like EBRD working on those auctions actually gives a lot of credibility. It also gives assurance that there will be financing once these projects are out there. And we can therefore attract strong investors like Aqua. We can get them sharpening their pencils, using the technology to deliver the lowest possible prices. And let me give you two quick examples, very successful examples of this. One was our very first project that we did under this program, which was the 200 megawatt Kamombo solar project in Egypt, the first competitively tendered solar project in the country. It took 4 years of work with the Egyptian authorities, but it finally rewarded the country with the lowest tariff achieved at the time in all of Africa. And of course, it was Paddy and Aqua that delivered the project. We were also the major lender in the project financing, which closed earlier this year alongside a number of commercial banks and other multilateral lenders. And Rod, I think both Paddy and I hope this will feature prominently in your PFI awards for 2021. And very quickly, let me mention another very recent auction, which again, Paddy managed to beat everybody else to the finishing line on, which is a 100 megawatt wind auction in Uzbekistan. You know, this was yet another project, the first wind auction in the country, but set a world record because of fierce competition. But it's also had such a strong demonstration impact. And this is what is really key in whatever we do, that we're already working on the next 200 megawatt project adjacent to this one. And also very importantly, and this is particularly something Richard talked about in his introduction, this project and all the following projects will generate jobs and deliver against several SDGs in one of the poorest regions in the country. It's the region around the disappearing Aral Sea, devastated by climate change. And very quickly moving on to the second program that we have, which is the work we do on delivering infrastructure projects for project financing via our PPP preparation program. And we call this the Infrastructure Project Preparation Facility. So we're currently working on about 15 PPP advisory mandates in various countries: Kazakhstan, Ukraine, Egypt, Uzbekistan, Jordan. These are mainly social infrastructure, logistics, transport. And again, the aim is to get these projects right for project financing, and then they should be replicable so we can grow the pipeline of such opportunities. One of our most successful examples recently was the one we've done with Julia in Meridian, which was the Sofia Airport, where we were involved not only in the tendering as the transaction advisors, but also we came in as partners in the equity, and we helped close the debt project financing as well. And another very interesting one recently is the 6th October Dry Port project in Egypt. Another project where we worked about 5 years to get this first of its kind green logistics PPP off the ground. And now it's been so successful that the country is working on 8 more such PPPs. And so the key takeaway here is we need to set bankable examples, but ones that are not one-off. They can be scaled, and we need to get the first projects right so we generate a much longer and deeper pipeline of such projects and bring them to the project financing market.
Thanks, Nandita. I think capacity building and constraints has been mentioned a few times today. When you go to a country and use your advisory and the various other services you're offering, what are the key takeaways? What are the key things you look for in terms of helping sovereigns build up their capacity?
Well, we do a number of things. One of the first things we look at is really the big picture. We look at whether they have the right strategies. Have they really understood how they need to prioritize? What does the long-term prognosis look like for that sector? And we help them in the basic planning and strategic thinking part of that. We also go in and do direct capacity building. We set up units like the kind that Paddy referred to, PPP units or a renewable auction unit. We do a lot of training. We do enormous amounts of training. We have various programs that we actually pick up high potential individuals from ministries and governments very early on. And we ensure that we train them and we send them right back so they can actually work then alongside us on those advisory mandates we have. We don't want to be doing it for them. We want to do it with them. And when I say about getting those first projects right, what we ideally want is once we've done that first project is they can go on and do the others on their own. The 8 dry ports we're talking about, we have 1 more mandate, but the other 6 or 7, they might very well do on their own. And that for us is real success.
Thank you very much. So moving on to Graham Winter.
Thanks, Rod. Well, one of my friends likes to describe project finance as like running a restaurant, which is a slightly peculiar analogy, but bear with me. So what he basically means is if you lay the table right, you have nice cutlery, starched tablecloths, good chef, good wine list, good lighting in your restaurant, build it and the diners will come. Right. So basically, the point he's really trying to get over is get the fundamentals right. And I want to refer to a report that was done a few years ago now by a research institute called the Bingham Centre of the Rule of Law. I am a lawyer after all. And the Bingham Centre commissioned a report from the Economic Intelligence Unit, which was finally called Risk and Return, Foreign Direct Investment and the Rule of Law. And what they were trying to do was they were trying to sort of carry out some proper empiric research to work out whether there is a link between the rule of law and the amount of FDI. And the methodology was relatively crude. They spoke to various senior executives involved in investment decisions. 40% or so were headquartered in the US, 33% or so in Western Europe, and 15% or so in Asia. And the conclusion, looking at the rule of law, was whether a destination country possessed strong rule of law. That was identified as the 3rd most important factor in selecting the location of foreign direct investment in their companies. The top two factors, incidentally, were ease of doing business and the existence of a stable political environment, which both, of course, extend to some extent on the rule of law. The report also looked at red flags for FDI, and not surprisingly, the three biggest red flags were the prevalence of corruption, political or social instability, and the lack of transparency in rulemaking. Lack of recognition of intellectual property rights was also pretty high on that list of red flags, by the way. And we've heard Paddy and Nandita already talk about well-regulated, well-structured environments, transparent frameworks and decision making. And I think all of these things from a legal point of view are absolutely fundamental to attracting investments into infrastructure projects, in particular in developing countries. And there are some quick fixes that you can do. Countries can enter into bilateral investment treaties to give investors comfort that they will have the protection of that treaty if they invest. And they can also accept international arbitration for some of the key project documents with government, for example, concession agreements. As I've already mentioned, I think if you're looking at speed, if you're looking at scale, one of the things that countries should definitely do is not try to reinvent the wheel, but try to educate themselves on what international best practices in international project finance and try to stick as close to that as they possibly can.
Graham, is maybe it's old hat, but marrying the local legal framework and the international legal norms a key issue when people are structuring projects in the emerging markets?
I think it is a key issue, Rod. I think the problem normally comes when you actually need to change local law. For example, to allow in Paddy's field, independent power projects to be attached to grids, national grids, and you have an incumbent utility, usually a monopoly. And that sort of change can be quite cumbersome to implement because it normally requires primary legislation. I mean, that shouldn't be overlooked. And I think countries that really want to scale up project finance in some of their sectors definitely need to do some form of scoping program and research initially as to how they need to enable project finance in their own legal framework by, for example, making exceptions to monopolistic rights along the lines that I've just mentioned. It is a key issue.
Thanks very much. Moving on to Jorge Abash at CAF. Welcome, Jorge, to our session.
Thank you, Rod. Building on what Paddy, Nandita, and Graham have just mentioned, I would add 2 points and another comment. One is related to market attractiveness. Countries should consider developing investment programs instead of isolated projects in order to attract sophisticated global players, who in turn could bring alongside best practices related to sustainability investments, as mentioned before. And another point is related to the need to demonstrate strong commitment towards sustainability. Countries have to develop comprehensive and robust yet uncomplicated ESG framework based on international best practices and the well-known principles such as Ecuador Principles, World Bank Group's IFC's performance standards, and others. This must be clear and transparent, environmental and social regulations, but also easy to implement. Elements that must be included in these frameworks should include social and communities must be engaged early in the process by carrying out social consultations, develop a clear and auditable mechanisms to establish and account for social and cost-benefit analysis, create stronger regulatory bodies with sufficient power, teeth, and budget to enforce attainment to ESG regulations and project industry levels, And finally, establish modern and effective monitoring systems based on international best practices able to identify promptly different forms of non-compliance. DFIs such as CAF, EBRD, and others play an important role in ensuring that ESG principles are properly included in the project structuring, reflected in the contractual arrangement and monitor it during the lifetime of project. CAF's ESG specialists get involved early in the assessment of their project and establish ESG risk category, participate in the drafting of legal documents to ensure these capture adequately ESG issues, and the environmental and social assessments plan is prepared, followed by an environmental and social implementation plan during project execution. These measures give enough confidence to commercial banks and sponsors that ESG principles will be followed according to best practices, even if these projects are in less developed markets. By the way, at CAF, we have a team devoted to advising countries who are willing to launch bankable PPPs, so they are appealing for both local and international investors. And the final comment is that CAF provides grants to project preparation. Just to mention a recent, very interesting project, which is the Humboldt cable linking Chile to Australia. This is a submarine cable. And a very final comment is related to training. CAF has launched a mock framework for training officials from countries in the region in very interesting and deep courses on project preparation, PPPs, and other related matters.
Thank you, Jorge. You mentioned transparency. How do you encourage your sovereign members to have transparency in projects, or to increase the transparency in their project procurement?
Well, from our side, we, beyond what I just mentioned, where we advise governments in framing the PPPs and their institutions that take care of this agenda, we, by definition, impose this framework for all projects where CAF is involved. We are also providing technical assistance to many governments, including ones that are just launching these frameworks, including Panama, Dominican Republic, and others, so that they can start fresh with the right framework related, including things on transparency, governance, and others.
Thank you. Jorge has mentioned Sustainable Development Goals. I'll move on to that as a question in a few minutes, but I'd just like to ask a quick question of all our panelists. Are there any key financial and legal issues? I think we've touched on already, but are there any key issues they'd like to raise in terms of raising project finance in the emerging markets? Paddy?
I mean, look, there is a whole bunch of issues to do with convertibility of currency. You see, okay, so infrastructure by definition means that revenue is going to end up being generated in local currency, whereas the inputs are all in foreign currency. The loans come in foreign currency. The investors are from around the world. So there's a currency mismatch straight away. So beyond creditworthiness, ability for the local utility to pay, and the sovereign guarantee, all that kind of stuff, there is the issue around convertibility assurance and the availability. So you can have convertibility guarantee, but ultimately, if there is no US dollars in the central bank, that year or that 6 months, then you have a challenge. So there's a bunch of issues like that. But having said that, our experience is that, look, with the right counterparty, with a willing participant on the other side, who are not going to sort of cling on to dogma, how dare you question my sovereign guarantee? Well, sorry, you were not around for such a long time. I'm not going to trust it. Thank you very much. So long as they're willing to work with you in a very sort of open manner, it's not just about transparency, it's the willingness to work with you. There are ways to structure these things. So, I can give you a long list, but every one of those issues we can overcome, provided there is the willingness on the counterparty side to want to do it, and to do it efficiently, do it quickly, and not procrastinate over it.
Thank you. Actually, take the opportunity, Paddy, to ask you about some of the supply chain issues at the moment. How are you as a leading developer dealing with those?
Okay. So there are two things that I do want to sort of highlight to everybody. And look, and these issues come up and they go away, and the world sort of mumbles on and bumbles along. Supply chain is a huge issue today. Supply chain and the massive volatility in primary metals and a whole lot of and fuels and so on is an issue. Our view is that this is something that is temporal. History supports our view. And I think it's many people's view. So the best we can do, again, you need willing counterparties to sit and discuss with the counterparties, to slow things down a little bit and give more time for these things to even out, so that you don't end up putting your partners, your contractors in difficulty. And delay things unnecessarily. So this, I think we can manage, but it is something that needs to be dealt with very proactively. The other issue, which I think is very concerning, is the geopolitical issues. It is, I'm sorry, the tension between the United States, between the US and China, and it's not just the US now, it's a group of nations, the Western alliances, if you like. And China is an issue, and that I think is going to have a bigger impact, because those kind of issues take longer to resolve and longer to even out.
Thank you, Nandita.
Thank you, Rod. It's always a bit of a challenge coming after Paddy, because he always somehow manages to say what I wanted to say. And I think it's probably even worse for the speakers that follow. So let me zero in on one issue, which we are very focused on at EBRD, and which we think really affects the long-term affordability of project financing, and that is the currency risk. And I'm sure, Rod, you have a compendium of project financings in developing countries that tanked because of a major currency devaluation, and governments just reneging or forcing renegotiations when they could no longer afford the payments under foreign currency denominated or linked contracts. And Julia, if she was here, would remember this very recently. We had this with the Turkish hospital PPP program, a very successful PPP program, which was in lira, but was linked to a foreign exchange. And as soon as there was a devaluation of the lira, it quickly became clear that it was favoring the investor more than the government, and they went straight into a renegotiation on every one of those contracts. And so, this is something that we've been quite focused on for a few years now. And what we try to do in our countries is to find a way to actually mobilize long-term local currency financing, because we really think that ultimately that is the solution, is to deepen the local capital markets and find ways to raise money that we can then lend to our projects. And we have actually a dedicated team that works with central banks, with ministries of finance in our countries, and really helping to do this. Our ideal is in countries where we're able to issue our own bonds. We use our own AAA rating, but issuing a bond in the local currency. And then we use the bond, the currency we raise, to then back-to-back lend to projects. Sometimes we have to have other interim arrangements, such as swaps with the central bank or hedging arrangements, but we really, really make an effort in almost all of our countries to find ways to raise local currency. And let me give you an example of a country where, if we hadn't had that local currency, we probably would never have got them onto renewables, and that's Kazakhstan. Kazakhstan had just started a very nascent renewable energy program around the same time as they had a major devaluation of the tenge. This was about 2014-15. And so they decided that they were only going to offer the feed-in tariff in tenge. They were not going to do any indexation, nothing, because they had just suffered so much from this major devaluation. So what we did was we really stepped up this local currency program, and first via swap arrangement with the central bank, but later by issuing our own CPI-linked tenge bonds, we mobilized tenge debt for up to 13 to 15 years. and we got nearly 600 megawatts of solar and wind projects financed that would just never have happened. And of course, you know, there's always a multiplier effect, because once we started to do this, other MDBs started to tap in, local banks started to come in and realize that they needed to access Tengi as well. And so it's just an example of showing what, with enough effort and focus, if we can do this raising of local currency financing, we can avoid that trap that a lot of project financings do fall into. This is the most natural hedge that we see, is really providing local currency financing.
Just very quickly taking that on, we had a question about encouraging local ownership of projects. I guess that's something that's close to your heart.
Oh, absolutely. Absolutely. That's absolutely close to the heart. And it has to really be meaningful for the country, for the people, for the local community, as Jorge was also pointing out. You know, it has to work for everyone to be sustainable in the long run. You know, we talked about the Turkish hospital PPPs. Well, during COVID, the hospital that actually Meridiam financed ended up being a COVID hospital. And if they didn't have that state-of-art hospital built, they wouldn't be able to have those facilities. And that's when it really, that's when the ownership really steps up, and when they realize the value of these kinds of projects.
Okay, Graham.
Yes, thanks, Rod. Well, I absolutely echo this point that there's a whole myriad of potential legal issues that can arise in an average project financing, and it's difficult to know which one to pick upon. But actually, I think the good news is that you know, with the wealth of experience that we now have in the sector, I think, you know, there are many ingenious solutions. So if you need an offshore bank account with security given to the banks for foreign currency payments, that's nevertheless fair and doesn't seize up the operation of the project because you can't get enough money to actually pay for the OPEX or the maintenance bills. All of this stuff is old hat really for practitioners in the field now. So there's been a lot of ingenuity deployed over the years, and most of the legal problems can be overcome. And I think one of the things.
Oh, sorry.
No, go ahead.
We had one question about which I think relates to the Equator principles which were mentioned earlier on, but how to involve local communities in negotiations on projects, which is an important. Does the Equator principles deal with that adequately, do you think?
Well, I think between the Equator principles and good corporate practice, I think you know, you should have an adequate treatment of the issues around indigenous peoples and local populations. I mean, before my current life and incarnation as a lawyer, I was in-house in an energy company, Rod, and we went to great pains just because of our own reputation to make sure that we engaged with the local indigenous populations in Australia and the First Nations in Canada with our LNG projects. And it's something you want to do as good corporate governance, frankly.
Yeah.
But I think the other thing I would say has also been mentioned in relation to legal issues is this whole issue about the four corners of the contract doctrine. It's important for people to understand that project finance almost exists in a parallel universe. What you're trying to do as a structure or as an investor, a developer of one of these projects, is to create a contractual framework that stands on its own 2 feet. Where risks are passed off and taken by creditworthy counterparties or by insurers, and anything that can disturb that you know, rather delicate ecosystem won't help your project financing. So once you've agreed to these contracts, they should be left alone. You shouldn't really try and reopen them, and there shouldn't be reopening clauses in the contracts. The other thing I think, by way of legal challenges, it's important for countries to understand that sometimes there must simply be some form of government support on one thing or another for a particular project to go ahead. And actually, even without a central bank guarantee or some other financial support from the government, there's always a risk that outside agencies, in particular rating agencies, will apply a concept of the implicit guarantee, right, which is actually, if this toll road goes wrong, right, we know there is no alternative but for you, the government, to step in to take over the running of the road. And therefore, when assessing your credit rating as a country, we're going to look at the debt that's been raised on that toll road. There's always that risk. And the real defense against that is a well-structured project that never goes into default in the first place.
Okay, thank you, Graham. So moving on to Jorge, any key financing and legal issues that you come across in infrastructure financing?
Thank you, Rod. Mandita said that it was hard to speak after Paddy, and it's even harder to be the last one in this brilliant panel. Few things left to me. Well, just to highlight a few topics related to the financial issues. One is the limited depth of local credit markets to fund large infrastructure programs. That's, by the way, an important issue here in Latin America. Another one is the lack of sophistication in local financial sector and limited understanding of structured finance solutions in local markets that could affect the ability of some institutions to seek opportunities in certain markets.
Yeah.
But another is related to the topics. It's related to affordability and capacity by contracting authorities, mostly in PPP schemes. They may not always have enough physical space to honor obligations under PPP contracts, as we saw last year and this year in some countries in the region. Another one is related to local accepted accounting principles, not necessarily aligned with international best practices. Another one is related to a reasonably good and stable credit rating of the host country, as already mentioned. And finally, a reasonably good and stable foreign exchange and credit markets. I think that in a nutshell, this may characterize well some of the main financial issues faced by emerging economies, including the ones here in Latin America.
I mean, in Latin America, do you find as an issue in terms of sometimes the public sector funding solutions crowding out the private sector funding solutions?
Probably in the recent past, but because of the fiscal crisis, the fiscal space has been reduced so much over the last years that we more and more see governments welcoming PPPs and other arrangements. So that's what we are seeing are that the prospects for attracting private investors is increasing very much. So this crowding out is perhaps no longer a key topic as it was in the recent years.
Yeah. Okay. So moving on to our final topic, which concerns how critical ESG and sustainable development goals when raising finance and developing projects. So I ask our panelists how the ESG agenda has affected the way they do business, maybe starting with Paddy.
Look, environmental stewardship, social responsibility, and corporate governance are, look, it's now structured into this bucket. But the fact of the matter is, if you take those three components very seriously and integrate them into the projects, you intrinsically significantly de-risk social responsibility, not giving charity, but about trying to involve the local community in that infrastructure asset. South Africa Renewable Energy Program is stunningly, it's something that I invite everybody to really seriously look at. How they have managed to structure local community ownership even through trust structures, giving them a sense of ownership in those projects, generating a little bit of revenue on those on a consistent basis through the life 20-25 years, utilizing that revenue then for improving the infrastructure around them or improving education, healthcare, and so on at a local level. So there's so many different ways to do it. So I think everybody now understands the importance of having these three components being central to the project, and they're looking beyond the project to see whether these are really taken seriously at the macro level by the country itself. So it's not just about the project ESG credentials and how they're integrated, but also looking at how the macro framework encourages it, supports it, places a priority on it. So it is becoming very critical, and it's going to become. There will come a time in the not too distant future when you will not be able to get sort of financing at any sensible basis for projects that don't include these three themes in the structuring of the project and in the macro environment.
During the IPO, how intensive was the questioning on these topics?
I personally kind of took part in over 140 analyst presentations. Very, very interesting. I would imagine at least 75+% really quizzed us. I mean, we have issued a very thick prospectus. Okay, maybe they didn't go through all of it, but they were very focused on looking at not just about, oh, okay, we are so heavily known for the renewable energy agenda that we have and so on and so forth, but we do have one coal asset in our portfolio. Man, that coal asset came under a huge amount of attention. But it wasn't just that. It was about our own practices as well. How is it that we are encouraging in other words, digging deep? How is it that we are encouraging and ensuring that our supply chain complies with some of these obligations, about inclusion and diversity? They were really, everybody is now buttoned onto this. So it has become very critical now.
Thank you, Paddy.
Rightly so, rightly so.
Nandita.
Yeah, thanks, Rod. And of course, yet again, I can only agree with Paddy. ESG for MDBs like ourselves, and I think Jorge described that very, very well. It's in our DNA. We've always done this. Every project we ever looked at had to meet these high standards. But what we definitely see now is other investors, other lenders are now converging to thinking the way we do about these things. And I think Paddy described that very, very well. But let me just spend maybe a couple of minutes telling you what has really become critical for us, and it's not just us at EBRD, but all MDBs, in terms of how we're looking at things going forward. And right now, what we are all focusing much more on is Paris alignment. So we at EBRD have declared that by the end of 2022, every one of our projects and investments will be aligned with the goals of the Paris Agreement. So this is in addition to a commitment to becoming a majority green bank by 2025. Now, in practice, we're already embedding this in our decision making, and we're already screening every new project for Paris alignment. So this is a principle that forces us to think holistically about what a net zero transition means for both our countries of operation, but also clients at the company level, as well as the country level. It requires us to work with the countries to ensure they've got robust NDCs, help them develop low carbon pathways to meet their respective Paris Agreement goals. And what we need to ensure is that every project we finance is consistent with these pathways and NDCs, and at a minimum, do no harm. The methodology is still evolving. We're working together with other MDBs on this. Each MDB has made a commitment, some with different timelines on this, but it's really, I think, something that going forward is going to become very important. And let me just say here that we don't just see this as a sort of compliance function. We really see it also as a way of finding opportunities. And I'll give you, again, a very quick example. I've just come back from spending last week in Uzbekistan, where we've actually already worked with them on developing a low carbon pathway for the energy sector. We're also working with them on an economy-wide long-term strategy, but we focused first on the energy sector because there's just so much activity going on there. And that work has been so helpful to the Uzbeks that they just announced, just in time for COP26, that they're going to scale up what was already an ambitious target of doing 8 gigawatts of renewables by 2030 to 12 gigawatts. And they've done this on the back of having done the work on the long-term strategy. But just imagine, that's 4 gigawatts more for private investors to fight over to deliver, and 4 gigawatts more of project financing. So really, we really see working on aligning with Paris Agreement also going to be a way to generate new and different opportunities for countries. And I'll stop there.
Thank you, Nandita. Graham.
Yes, thanks, Rod. Well, I mean, for me, I think having a good ESG program is essential to having your license to operate as a company and being a good corporate citizen. I think what I'd like to focus on, sorry for sounding a bit like a car mechanic, is really measurability. Measurability of what you as a developer or as a project say are your ESG goals. I mean, what do you really mean? how's it going to be measured and how you be held to account? I think these things are quite key. Otherwise, it all becomes so much hot air. There's a sort of interesting aside in my firm. There's part of the firm that's got a very interesting sideline at the moment, advising companies who are making various claims about the sustainability of their products. You know, maybe it's, you know, this is a low carbon TV, or this is a net zero burger. Yeah. Now, if you're going to make claims like that in your marketing, especially in a market like the United States, you better be prepared to back it up, right? So I think what I would say in relation to all of the debate around ESG at the moment is, you know, if you're going to make these claims, then let's work out how you're going to justify them, and let's measure them and hold you to account.
Wow, I bet those guys are popular.
Well, they're in demand.
Anyway, so finishing off with Jorge.
Thanks, Rod. Developing countries, as mentioned, typically have weaker institutions that often results in less than adequate ESG risks, identification, mitigation, and monitoring. However, many investors, at least here in the region, are taking care of their stakeholders while monitoring externalities, and the externalities are benefiting from their commitments. The ESG principles are being broadly incorporated by sponsors of projects in their activity because they're weight for investors. International financial institutions, again, such as CAF, are working in emerging regions, are adopting ESG principles and frameworks from various recognized entities, as I mentioned before. These practices permeate across emerging markets when attracting sophisticated investors such as Paddy and others who are also demanding these frameworks to be implemented. CAF has decided to become the green bank of Latin America, and we are aiming at that at least 40% of our portfolio will be ESG and green. One very concrete way to implement this agenda here at CAF is by working very directly with our allies and clients, such as national development banks. We have as clients many of those banks here in the region, and we have established a framework for working with them as a frontliners, so that we want to make sure that this framework, this agenda is being in place in the region.
Thank you very much. I think we're now coming to the end of our session, so I'd like to thank our panelists for their time this morning. I think it's been extremely worthwhile. Hopefully this webinar will remain online for all sorts of people to view into the future as well. And I'd like to hand back to Richard just to wrap up the session.
Thanks, Rod, and thanks for leading this discussion in such a smooth way. Very well done. I think it was extremely insightful. Thank you very much to all of the panelists. Really appreciate your contribution. I got a lot of things out of this. Just to mention, to pick three randomly almost, right? I heard one remark or earlier on, the tone was extremely positive, and I heard that basically in low-income countries or in developing countries, there is a possibility to develop big infrastructure, international project finance projects, as long as the government is willing to do so and do not procrastinate over it. I thought that was an extremely positive note, so we can work on this. Another insight I got was we've been hammering, I think, for years now in international organizations on this idea of bankable pipelines. We need to help developing countries build bankable pipelines. And what I heard here was at some point, we need to actually help them to build a bankable pilot. Because what I heard was if you get one going, then the rest will follow. So I thought that was interesting. And then, of course, the focus on sustainability we got towards the end of the discussion was very good. And if I look at the data, by far the biggest sector and the biggest growth sector is, of course, the renewable energy sector in project finance. And what I heard early on in the session was it all started out decades ago with actually only the mining and extractive sector, so fossil fuel energy, and now it's moved on completely to renewable energy. So I think that transition is an interesting development. So as I said already in my introductory remarks, we in UNCTAD plan to do much more work on this. So really appreciate this session to provide us with some guidance, and we hope we'll be able to continue to benefit from your advice as we go along. Thank you very much again for your contribution, and I hereby close this session. Thank you.
Thank you.
Thank you.